At the end of last week, I completed my full 1-year cycle of trading Strangles on QQQ, which is the Nasdaq ETF. And in this short video, I'm going to show you not just the results, not just how I performed against QQQ, but also I will do my best to replay what happened over the last 12 months. So stick with me. It's very exciting, very interesting, and I bet you will learn a lot from it. On this first slide, I'm going to show you my position versus QQQ. I am showing you the QQQ in a candlestick chart, which for some might be a little bit challenging initially to get the hang of it. But the key thing is that you can see these red lines. They indicate that on this particular day, the QQQ fell. And on days when the candlestick is green, and then the QQQ traded higher by the end of the day. So I started documenting my QQQ strangle trades on the 21st of April 2022, and that's when the market was in an absolute turmoil. So I really wanted to see how I would perform even in a very challenging environment. So you can see that in April and May, it seemed like we are going to experience a massive market collapse similar to what happened in 2007, 2008. And you can see that originally QQQ was trading above 340, and then very quickly within a few weeks it went all the way down to approximately 285. So it was a very rapid move downwards. The red line indicates my call position, my short call position, and the blue line indicates my short put position. So for those of you who are new to options trading, a strangle means that you sell a out of the money call option and an out of the money put option against a particular underlying, in this case QQQ. The whole idea of trading strangles is that you want the stock price to remain between your call and your put strike. And quite often what we find is that we have to make adjustments on the way because the stock price isn't going to remain at the same level for the entire duration of our strangle. So in this instance, in the first month, I had some major challenges, and as you can see, I went inverted with my strangle. My call strike was much lower than my put strike, and that's because, as I said, the QQQ and the entire market was in a massive mess, and it really appeared that we're going to see another GFC. So I went heavily inverted, and then it was time on the 18th of May, so approximately a month later, it was time for me to roll my position to the following month. So rolling a position in strangle means that initially, when I started documenting my QQQ positions, I had the May expiration on my call and put options. And then when I got closer to expiration, then I rolled to the June expiration, which means I closed my May positions and I opened another position expiring a month later. So that's what rolling means. So on the 18th of May, I rolled a month out and I widened my strikes. And as you can see, I went from a heavily inverted position to a normal strangle. Kept my position for about a week and a half, and on the 27th of May, I rolled again to another month and widened my strike further because there was a lot of uncertainty in the market and I wanted to be as far from the actual price as possible. On the 24th of June, I rolled again, and as you can see, between each roll, there is several adjustments that I had to make. So for example, when I had the call strike up here and the market started heading downwards big time again, very, very quickly, you can see over here from about 310, within a couple of days, the QQQ went to 270. That's a very rapid movement. So I had to adjust my call position down to collect additional premium, but I kept my put position where it was. And on this day, my put position was tested. In fact, it was breached, but I just kept my position hoping that we are going to see a little bit of a bounce back, which did take place. So on the 24th of June, I rolled again to the next month and I widened my strikes again. And as you can see, every single time I rolled to the following month, I widened my strikes. And that's because options that are expiring later in the future, they are always more expensive than options that are expiring closer to the current date. So when you roll to the following month, then it allows you to collect additional premium. On the 25th of August, I rolled again. You can see that we have seen a big bounce back in QQQ. So once again, there was a lot of uncertainty. Okay, we have seen this big bounce back. The market was widely expected to collapse, but then after a few weeks of intense rallying, I widened my strikes as wide as possible, thinking that the market can go either way from here. It can either go down or it can go up. So I went really, really wide with my strangle. And as you can see, QQQ once again had a really steep decline. So I just kept on rolling my call side down. In fact, QQQ went well below my put strike, which obviously put a lot of strain on this strangle, but I didn't want to go inverted at that time. I just had my call strike at the same level as my put strike and then waited a couple of days before I rolled to the following month again on the 4th of October, which once again allowed me to widen my strikes. And then a month and a half later, in mid-November, I was once again in a situation where my put strike was tested heavily, and then a couple of days later my call strike was tested and breached. So it was a fairly challenging period, but then fortunately for options traders who are selling options, time is in our favor, and I was able to widen my strikes again by rolling to the following month in mid-November, and then a couple of weeks later I could roll again. So when do I roll? Normally I try to roll around 3 weeks before expiration. That keeps your account relatively stable, but in some instances, when there is a lot of uncertainty in the market, I tend to hold on for a little bit longer, for as long as I can with my positions, because I want to make sure that when I roll my strangle, I roll it to the most ideal strikes on both the call and the put side. So that's why sometimes I hold my positions for a little bit longer than the usual 4 weeks or so. So once again, I kept my position, and in the beginning of January 2023, my put side was tested again and breached, but I was able to roll again and widen my strikes. And then a few weeks later, I rolled again. And basically what I'm doing is I'm just trying to keep my strikes away from the actual price. That's basically what you do when you keep rolling your position. So as you can see, over the last 12 months, QQQ was moving quite wildly. So I had to make a lot of adjustments, and basically where I am today is that I've got my call strike a little bit closer to the price of QQQ and my put strike is much further away, and that's because there's a lot of macroeconomical issues, so I'm not comfortable rolling my put strike much closer. Also, we'll see it in the coming slides, the overall volatility is quite low nowadays, and when the volatility is low, then it's actually very risky for options traders to go close to the actual price with their strikes, because if volatility increases, then very quickly the buying power that you need to keep your position jumps. So let's go over to the next slide, and I'm going to show you how the VIX was moving over the last 12 months. So as you can see, at the end of April last year, the VIX was up quite often around the 34, 35 mark, and that's considered quite high. VIX more often trading around the 15 to $18 mark, but because there was a lot of uncertainty, the VIX jumped. And for those of you who are new to options or not familiar with options, when the VIX is high, then option prices are high. When the VIX is low, option prices are low. And that's because the risk is much higher when the volatility is high in the market. So that's why option prices are higher. So just think of let's say a car insurance. If you have a vehicle that is normally stored in a safe environment, then the insurance is going to be much lower than if the vehicle is stored in a more dangerous environment. So let's quickly take a look at what happened in May. The VIX was heading down towards 25, but still there was a lot of uncertainty, and then it very quickly jumped back up to 35, and then it started going down, reaching 20. So you can see that when the VIX was quite high, my strikes, I tried to keep my strikes quite far from the actual price. And that's because option premiums were very expensive. So I was able to make a decent amount of money even without getting close to the actual price. Now, at this point where I had a straddle, which is my call strike and my put strike was at the same level, and my put strike was breached by QQQ, the volatility was very high. So that was a very, very tough period. But then fortunately, I was able to roll to the following month and widen my strikes, survive another few weeks, and then rolled again, widen my strikes. And when the volatility goes down, that's when you actually see your P&L going up, because the value of the options that you sold diminishes. But then when you see the VIX going up, then you experience exactly the opposite. The only thing that consistently is in your favor when you sell Strangles is the time decay. So every single day is in your favor. Every single day, the theoretical value of your options diminishes. But then the volatility has a much greater impact on the option prices. So that's why you have to make sure that you keep your position as safe as possible by being a safe distance away from the actual price. You can see that the VIX is now trading around the $16 mark, and my Strangles are closer to the strike price than where they were when the VIX was trading around the $30 mark. But I will most likely widen my strikes because I don't want to be in a position where the VIX jumps up to, let's say, 25 to or even 30 or even above 30. Then I will find myself in a very tough position again. So it's all about keeping your position safe, keeping your account safe, because you are better off making smaller profits than risking big and losing big. So let's move on to the next slide. I'm going to show you my delta. So for those of you who don't know what the delta is, the delta gives you an indication as to how much the option value is likely to move based on the movement of the underlying. And it's also a great indicator to the probability of your strikes being tested by the underlying. When you have a strangle, then what you want to aim for in most instances is that you want to be neutral. So it doesn't really matter which way the price moves. One side will always suffer and the other side will always win. And as long as you keep your strangle more or less in a neutral position, then you will be safe. So when the delta is in a positive figure, then basically your strangle is bullish. When it's a negative figure, then your strangle is a bearish strangle. So you can see that I was quite bearish most of the time. If I keep fast forwarding, you can see that although I did attempt to be as close to the neutral as possible, I also did not trust the market and I kept myself more on the bearish side. Over here, it appears that I was bullish, but that's because QQQ had a really steep decline in a very short period of time. So naturally, my position appeared to be bullish, but then as soon as I had the opportunity to roll, I brought my delta closer to neutral and then eventually ended up being more on the bearish side. Today, I'm still quite bearish in the overall market, so that's why, like I mentioned earlier, I'm keeping my put strike further away from the actual price because I think there is a much greater risk of the price going down, the overall market going down, and I don't want to be in a position where I was in October last year, where my put strike was heavily breached, and obviously that puts a lot of strain on anybody's trading account. So let's move on to the next slide where I'm going to show you my premium. So the whole objective with trading options is that you want to collect premium and you want to keep as much of the premium that you collected as possible. So when you trade Strangle and you just keep rolling, what you want to do is you want to keep increasing the premium that stays in your pocket. So you can see that when I went inverted, my premium that I collected jumped quite heavily, but then I had to give back most of that premium when I rolled to the following month, and I went from inverted to uninverted, and every single month I kept on collecting more and more premium. With every roll, with every adjustment, I received more premium, and sometimes when I rolled from one month to the other, then I had to sacrifice some of my premium because I was too close to the actual price. My strikes were too close and I did not like that situation, so I rather sacrificed some of my premium. So I went through this period over here, quite a few months, where I basically stagnated. I was not able to keep my premium because every single time I rolled to the following month and I widened my strikes, I sacrificed a lot of my premium. So this was not exactly a successful period. But then over the last 4 months or so, I was finally back on track. The market seemed to stabilize a little bit, and currently my premium is just under $2,500, which I'm quite happy about. That gives me plenty of buffer even if the market starts to behave very, very wildly. On the bottom over here, we can see my capital required. So more or less, in order to trade Strangle against QQQ, you need about $6,000, maybe $6,500, but then you also need to factor in a lot of buffer. So depending on your account size, I would suggest that if you want to trade QQQ, then you need at least $10,000 allocated to just for this Strangle alone, and that will keep you safe even when the QQQ is testing your position, for example over here. Moving on to the next slide, you can see my premium versus capital required. The red line shows my premium and the blue line shows the capital required, and the green line shows the premium percentage. I am not showing the premium percentage for the first 6 months because that would have given us some misleading indicators. So I only started showing the premium from about month 6, and you can see that more or less, if you do it right, then you can keep your premium percentage between 40 and 50%. And of course, some of it you have to, if you want to close down your position, some of it you will have to give back to the market. But if you keep your premium between 40 and 50%, then you are in a really good position. So let's take a look at the bottom line. The number of trades that I did over this past 12 months was 89. So I needed to make 89 adjustments and rolls. Obviously, out of the 89, there were 12 rolls and the rest of them were adjustments. And the total profit that I generated was just under $1,900. So this is basically taking into consideration that if I wanted to close my position at the end of last week when I completed the 12-month cycle, then I would have capped $1,889 of the total premium that I collected. So what does that mean? Well, the average capital required was just under $5,200. So $1,900 would represent 36% ROI on the average capital required. But then you would rightfully question that, okay, well, in some instances, the capital that you had to have against this position was much higher. So if we use the max capital as our benchmark, then we still produced 28.6% ROI in the past 12 months. And if you compare that to the performance of QQQ, which was minus 2.8%, and the SPY, which was minus 3.2%, then it's a tremendous uplift. So I encourage you to digest this information and really consider trading Strangles against these major indexes, because we just went through a really tough period over the last 4 months, and you can see that my results were significantly better than what the market produced, what the underlying index, in this case QQQ, produced. So it's a really good way not just to conserving your wealth, but also to increase your wealth. And I always like to do a little theoretical calculation based on the ROI that I produced over the last 4 months. So I was thinking that, okay, if I have an investment of $10,000, an initial investment of $10,000, and I was able to produce 28.6% every single year, then after 10 years, that $10,000 would be worth $123,582. So that's a tremendous return, because the return is actually exponential. And that's the beauty of trading options, that every single dollar you make, the following day, that additional dollar is yours to work with. So before I wrap up, I also want to mention that I have been trading SPY as well. I've done exactly the same thing with SPY as well as IWM, and those results will come out next month because I started documenting those trades a month later. So it will be quite interesting to see the results. So stay tuned. That video will come in about 6 weeks' time. And also, if you want to dig a little bit deeper and get a better understanding of the adjustments that I made every single day, I documented most of those trades. I documented it for the first, I believe, 10 or 11 months. So you can actually see every single time I made an adjustment. I have the link in the description. So if you want to check it out, please feel free to do so. And if you have any questions, observations, please let me know. And if you want to trade with me, you can also do so. But for $5 Australian a week, you can join our trading group, and I'll give you specific trades, and based on the performance of my group, those trades will make you money. So feel free to connect with me, check out the description for the links, and I'll see you on the next video. Thank you for watching.